It's Thursday, July 8th. Welcome to Market Foolery. I'm Chris Hill. With me today, Mr. Asit Sharma. Thanks for being here.
Thanks, Chris, and thank you for the honorific of Mr. Makes me sound like some kind of authority. I love it.
Yeah, you're a grown-up. You're an authority. You're an expert.
Finally. It's taken some time.
Yeah, for all of us. We're going to talk ETFs. We're absolutely going to talk about the lawsuit against Google. But let's start sort of big picture, because I was saying to you earlier today, this is one of those days when the lead story on Wall Street is fear. And I'm not saying it's unwarranted. You got some cases where, some countries where COVID cases are rising. That's certainly true in certain parts of the United States. We got the latest jobless claims data from the Labor Department. That was higher than expected. Throw in the fact that Japan has declared a state of emergency around the Olympics. And, I'm not transacting off of this fear, but I understand why this is the case today.
Yes. I mean, crazy to think, Chris. Yesterday, I think the Dow had a record close. And here we wake up this morning, things are completely different. Part of this is a larger conversation that investors are having as they look into the mirror, which is, what does normalcy look like? Normalcy for the markets, normalcy for the global economy. We've got this target for the U.S. Our economic growth this year is supposed to be somewhere between 6.5% and 7%. That's real growth in GDP coming off of COVID. And when we hear things about potential slowdowns in global growth, the Delta variant figuring into that, the fact that the 10-year Treasury dropped to about 1.29% yesterday, which is signaling that maybe growth expectations are slowing down. You take all that together and investors start to second guess these record highs and the fact that the market has been relatively healthy. I have no idea what normalcy looks like, but I know that jolts like this are going to get us to an understanding of what that is over the next few months.
Well, it also makes me think of something Tom Gardner has said for a long time, which is one of the best ways for investors to increase their holdings and sort of increase their chances that their investments are going to pay off. Double your time horizon. If you have the ability to think in terms of decades, or even years instead of weeks and months, as a lot of professional traders on Wall Street do, that's going to be to your advantage. And again, I understand. I'm not saying any of the things I mentioned at the top of the show aren't real, but it does strike me as one of those things that if you have a long time horizon as an investor, then hopefully you're less afraid today.
Well, it certainly makes it easier to keep investing, right? It is a little scary to see markets at all-time highs and so much uncertainty in the air. But if you expand that time horizon out, it gives you some room to be okay with the volatility, to be okay with the fact that the market really doesn't affect what you're doing on the ground as an investor, which is trying to find great companies with long growth horizons that are out there innovating in that global economy and are going to rise over time independent of what the short-term market sentiment reflects. And
you mentioned the market, the Dow hitting a new high yesterday. I think if not yesterday, then earlier in the week or within the past week, both the S&P 500 and the NASDAQ have hit new highs. And, what's the Buffett line? It's, when the tide goes out, then you see who's been swimming naked. Like, I feel like a corollary is when the market hits new highs, then you find out who are the people in your life whose income depends on you transacting. Because that's when the drumbeat gets a little bit louder from people who are saying, oh, take some money off the table. NASDAQ hit a new high, cut, take some of that money you've been making off of big tech stocks and put it to work somewhere else or put it in cash.
So true, Chris. And those folks, their time to make hay is days like this. Our time to make hay as investors, slow and steady, try to tune those voices out.
Apple has caught a lot of heat lately for how it runs its App Store, and I guess the silver lining here is that now Apple has company because the attorneys general of 36 states and the District of Columbia have filed an antitrust lawsuit targeting Google's App Store, arguing that Google maintains a monopoly for distributing apps for the Android operating system. I'm not a lawyer, but this is one of those situations where I'm having a hard time seeing where the harm is for consumers. I get that if you're in the business of creating apps, if you're an app developer, maybe this isn't the greatest situation. But for consumers like you and me, I don't know. I would not want to be in the position of having to prove significant consumer harm.
It's true, Chris. It's sort of hard to see this. I'll put the argument this way. So this it's sort of a summation of the argument from the state. So Google Play, the Google Store, has about a 90% market share for apps that are on Android devices, and no other store has more than 5% market share. Now, with that fact, you've got this other fact on the side here that Google charges a 30% commission to developers on top of some other transaction fees on its store. Now, there's a great argument to be made there that, look, if that pricing power exists, if apps developers are passing on that 30% cost to us as consumers, they might charge that anyway and take it all home. So it is always hard to make the argument that the commission fees that Google charges are costing the consumer. If you're a developer and Google doesn't charge those fees and people buy the product at that price, then that 30% is yours. So I see some difficulty there as well. However, this is, a big target that is on Google, and Apple is right there beside it. I want to read something from William White, who's the Senior Director of Public Policy at Google. He said, this was in an interview yesterday, I believe, or blog post, Android and Google Play provide openness and choice that other platforms simply don't. So this is firing a little shot at Apple. What that means is that you can circumvent the Google Play Store if you want. There are ways to get apps onto your Android device without having to go through the Google Play Store. Not so with Apple's iOS system. You've basically got to go through Apple's App Store to get apps on the Apple device. But both companies are charging these commissions to developers, and both are in the crosshairs of some regulation coming up. So I think it's par for the course for these two dominant players in the app ecosystems. And I guess to the point of these 34, 36 odd states that have brought the suit, there is no third app store out there of any size. I mean, it's basically two really big fish that are fighting it out in real time. So we continue to watch what happens on these fronts.
I love it when the big companies just take shots at each other. You know, like Alphabet is not a behemoth on its own, and they're and part of their response is like, hey, look at them. What are you coming after us for? Look at Apple. At least we're not Apple.
Yeah, I love the little petty pot shots. It brings some color into what are otherwise dry proceedings.
A reminder, because I haven't mentioned this in a while, if you're ever looking for more stock ideas and recommendations, you can, if you're not already a member of our Stock Advisor service, you can check it out. You get stock recommendations every month. You get Best Buys now. You get a lot. And you get 50% off just by being one of the dozens of listeners when you go to stockideas.fool.com. That's stockideas.fool.com. Our email address is marketfoolery@fool.com. Got an email from George Rigatiro, whose last name I'm almost certainly mispronouncing, so I'm sorry about that, George. He writes, do you take into account the composition of your funds when you're looking at individual stocks? Like many fools, I have the big tech names in my portfolio, but if you start to dig into S&P 500 ETFs or even the Fool 100 index, you already have a large concentration in these companies. As someone with a 401k that does not allow individual stocks and a poor fund selection, I have a large chunk in the standard index ETFs. Just wondering how much you look into the composition of your ETFs in your portfolio when looking at concentration? It's a great question, Asit. I have to say, just personally, I've got, my first big investment was an S&P 500 index fund. And I think I compartmentalize sort of how I think about that versus the fact that I own, companies like Amazon. A lot of the companies I own shares of are in the S&P 500 index fund. And that's like, I don't look at it as like, oh, I'm overweighted in that sense. I've got my stocks, and then I've got my S&P 500 index fund.
Yeah, I think it's a healthy way to think about it, Chris, to compartmentalize a little bit, because you want to develop your skills as someone who can pick great stocks and be able to hold them. And a lot of times you'll find, if you play this game long enough, a confluence behind companies you really like and companies the rest of the market really, really likes as well. So you'll find some doubling up of positions. So it's healthy to compartmentalize so you don't keep yourself from participating and getting a bit more concentration in a stock like Amazon.com, which hopefully will continue to pay off for you over the long term. To George's point, it is a great point. We know that a handful of mega tech stocks make up about 40% of the S&P's market capitalization. So what is an investor to do who's seeking some diversification and trying to avoid specific stock risk by investing in the market, only to find that these handful of stocks can propel the market on any given day and over the longer term? Well, one of the things that you can do if you're really worried about this is look for ETFs that have exactly the same S&P composition, but instead of being capitalization weighted, they are equal weighted. So there are a few equal weighted ETFs out there that an investor can look at. As for our own full 100 ETF, I should point out that has a bit of a deceiving construction. We select the stocks on the Fool side, Motley Fool subscription services side, based on our conviction. But we can't really run that. That's the other arm of the business. That's the asset management side. And then on their side, they have to go with market-weighted capitalizations as well. So even though we pick according to our conviction, that's an aggregate of our analyst team, our convictions on all these stocks. Once it hits an ETF product, it also becomes capitalization weighted. And so to George's point, you get some big names that are driving a lot of the change. I would say the other thing an investor can do is remember there are mid-cap ETFs that you can participate in. There are international ETFs. There's a whole world of ETFs that can give you a little bit of diversification. I know it sounds ironic to say this, outside of the S&P 500 index, which is supposed to be your diversification vehicle.
No, that's true, but it is one of those parts of the investing world that doesn't get as much attention as individual companies do, and that makes sense to me just from a business media standpoint. But it's a great point that a good way to diversify, if you're looking for I'm looking for not individual stocks, particularly on the international level. If you're just like, okay, how can I take a basket approach to a region of the world, but I don't want to pick individual stocks myself? And you can do that, by the way. I mean, you can go the Jason Moser route of I'm gonna find 4 stocks in this category, and that's going to be my basket. But you can also go the ETF route.
Yeah, I think it's a really fun way, in fact, to learn about other parts of the world that are emerging in terms of investment viability, and also some mature markets that we often overlook in our own backyard. You could look for a large cap stock which has an industrial focus, so that might leave out a lot of tech stocks. So ETFs give you that ability to play around, to diversify, to learn. And I agree with you, Chris, they're overlooked. And in some ways, they also are a great fund of ideas. One of the best things you can do as an investor who is both Diversifying through ETFs and picking your own stocks is to pour through the lists of the holdings of every ETF you buy and look at those top 10 or top 50 holdings. That can generate some very interesting ideas. Many has been the time that I've looked down one of these holdings lists and third or fourth, fifth biggest holding in X ETF is a stock I've never thought about owning for myself. When I do some research and a light bulb goes off, why don't I own this security on the side here? So I think there can be a healthy symbiosis between the stocks we're picking that we just really love and want to have in our portfolio and those ETFs, which give us a little bit more comfort, ability to sleep at night, and provide some ballast in our portfolios.
Got to watch the fees, though. You always want to make sure you know what the fees are, although that's another trend that has, in the same way that all these different brokerages over the past 20 years kept lowering their fees until finally they were like, the hell with it. We're not going to charge people for trading stocks at all. We've seen the same thing happen with mutual fund fees and ETFs.
Chris, you and I are both of a certain age, so I'll say no more than that. But you remember those net asset value fees used to be assessed, this is back in the days when everyone was buying mutual funds, the closed-end funds that would charge you on a sliding scale 5% if you tried to get out in the first year. And then you had the management fees as well. So the industry has come a long, long way in the investor's favor. No excuse not to look into ETFs. For the most part, the fees are very reasonable these days. We have to give Vanguard, of course, a lot of credit for driving that over the years.
My favorite, of course, is the 12B1 fee. And of course, it's like, oh, it's a alphanumeric, name. And it's like, well, what is that? It's like, oh, that's the fee we charge, and we take the money from that fee, and it goes towards marketing this fund. Like, oh, okay, I'm paying you to market this fund to someone else? No, thank you.
One that, until it was explained to you, looked so legit just by that mysteriousness.
It looked so official. It's like, oh, a 0.25% going to the 12B1, whatever that is.
It had to be something very legit, right? Something that had to do with securities law or the mechanics of operating the fund or some esoteric part of investing that you're paying for some expertise there. You're paying for marketing expertise. But that's how the world works.
Awesome, Shower. Great talking to you. Thanks for being here.
Always fun. Thank you, Chris.
As always, people on the program may have interest in the stocks they talk about in the Motley Fool, may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. That's going to do it for this edition of Market Foolery. The show is mixed by Dan Boyd. I'm Chris Hill. Thanks for listening. We'll see you on Monday.